3 stocks to buy to keep your money safe in the market. What's up, guys? My name is Chris. Let's get started. With this video, I want to go over like the PE ratios and the balance sheets and some year-to-date charts. The reason I want to do this is because a lot of people are talking about growth stocks, and a lot of times you don't even use PE ratios. There's not even a PE ratio for a lot of growth stocks, and the balance sheets are horrible on those stocks. And the year to date, we'll look at those, but that's why I want to make this video, and we'll jump right into it. So if you guys would hit that spicy like button and subscribe to the channel, maybe we can make some more videos like this and save a lot of investors from losing a lot of money in 2020 and 2021. Thanks, guys. First up, Alphabet, the largest streaming service out there. They own YouTube and many more platforms on Google. Let's take a look at their 1-year chart, guys. Looks like Alphabet is up almost 7% on the year. This is pretty impressive because they've outdone the Dow Jones. Dow Jones is only up, actually they're down 2.5% on the year. So that's pretty impressive. They've outdone them. Let's go into some of their revenue growth. Looks like since 2003, they've almost 100x their ad revenue. And you're watching this on YouTube, which is part of Google. So if you keep watching YouTube, their ad revenue is going to keep going up and up and up. I don't think anything's going to slow this stock down anytime soon. Let's look at the balance sheet, guys. Total assets of $275,909,000,000. Total liabilities of $74 billion. They could pay this off 3.5 times and still have money left over. Let's take a look at Alphabet's PE ratio. Now, this is a price to earnings ratio, which is a way to value a stock and see if the stock is overpriced or underpriced. It looks like they're at a 32, which is higher than their past couple years here. So, I mean, if you're looking for a good entry point, I would try to look for this PE ratio to drop below 30. If it gets into the 20s, I think that's a good buying opportunity. Second up here, guys, Facebook. Let's take a look at their 1-year chart. Looks like Facebook is up 25% on the year, which just really outperformed the Dow Jones, guys. They own Instagram and a lot of other social media platforms that they've got going. Let's take a look at Facebook's ad revenue. In the last 10 years, they've almost 100x their revenue. Facebook is a growing platform. They keep buying companies off the market, and they keep growing. Let's take a look at Facebook's balance sheet, guys. They got $133,376,000,000 on their balance sheet. That's freaking impressive, guys. Total liabilities of $32 billion. This company could pay off their debt 4 times and still have money left over. This makes them recession proof. Facebook has 1.8 billion users on it every day and 2.3 billion users on it every month. So I don't think that's going to slow down anytime soon, considering there's only like 7.5 billion people in the world. A lot of the world isn't even on Facebook yet, so I think they have exponential growth heading for them. Third stock up, guys, Lowe's. Now, this is a company that not many people talk about. Let's look at a 1-year chart. They're up almost 40% on the year, which again outperforms the Dow Jones. So you can see why you'd want your money in a stock like this compared to the Dow Jones or the S&P 500. Now, this balance sheet obviously isn't as pretty as Alphabet's or Facebook's, but it's still very impressive, guys. They got a total assets of $39 billion, total liabilities of $37 billion, which leaves them with an equity of almost $2 billion, guys. Let's take a look at some of Lowe's revenue growth. As you can see, they're steadily growing throughout the years. They made 71 billion last year, and they've already made 72 billion this year. So this number right here will be larger by the end of the year. So let's talk a little bit about Lowe's PE. It looks like their PE for 2018, starting of 2018, started at 18. It's been going through 20. So at the beginning of 2018, it was 24, 17, 20, 20. Throughout 2019, it gets a little higher. We go 30, 37, 31, 29, 21. As you can see, it's getting lower and lower. And now we are at 22. I think this PE ratio is a great buy-in point, guys. I mean, honestly, this stock is super undervalued in my belief. I'm no financial advisor, but the way that this stock was priced last year and in the previous years, it's fairly valued. If you guys are looking for a good stock to get into and to get some good gains, Lowe's might be it, man. And PE ratio 22.14. If you want to wait for it to drop to 19 or 18, that's fine too, but I think this is a good spot to start right here. If you made it this far in the video, I want to thank you guys. And the reason I'm not talking about growth stocks in this video is because everybody else on YouTube is talking about growth stocks. And like I said in the beginning, these stocks are solid companies. You're not going to lose much money in them. They're recession proof and you're always going to make your money back. These companies aren't going to go anywhere overnight. These companies, they're in there for the long run. Facebook, Alphabet, Lowe's, they're here to stay. They're not going anywhere. Like, a lot of people want to talk about Workhorse. A lot of people want to talk about growth stocks. And honestly, if you want to keep your money safe, these are the type of companies that you need to put your money in. Thank you guys for watching the video. Please hit that spicy like button. Please subscribe. Let's help out some investors today and share this video. Thank you guys. Have a great day.